Welcome to Silicon Valley Successes. On today's show, we have Chris Abato. She is the founder and president of Moneta Advisors, a boutique middle-market mergers and acquisition advisory firm. She has 16 years of MMA experience in the U.S. and U.K., having worked on deals from $1 million to $1 billion. With a background in aerospace, degree in physics, and an MBA, she specializes in high-tech exit strategies, and you're going to meet her in a moment. Chris, welcome to Silicon Valley Successes.
Thank you. It's such a pleasure to be here.
It's our pleasure. Chris, you have this amazing background. Can you tell us how you got into the role that you're currently in?
So I started out in physics, in solar physics, and realized that I was never going to be a Mozart there. So I realized that I needed to figure out, who I really am in this world, and hired a career coach, realized that business was really in my blood, so went and got an MBA after working in solar physics for a number of years, and got an MBA, and I felt like angels were singing. So when I did my first merger and acquisition, my buy-side deal at Lockheed Martin, I was just absolutely in heaven. I felt like I'd really found my place on this earth.
That's an amazing path in your career. So right into the questions, we surveyed a lot of people before the episode. And one question that came up was, when does a company feel like they're ready to be sold? And when should they approach an MMA advisor?
Yeah, that's a great question. And so typically clients or customers, clients will come to us when they're either ready to retire or the core senior staff is ready to retire, or they feel like the market is very hot for their type of company, or they've been approached by a company. And so it kind of planted the seed in their head that, well, maybe we should see what, how we would do if we go and sell. So those are usually the three scenarios that people will come to us and give us a call and ask us for our help.
So if someone says they're ready to retire, or someone's come to them and they're looking to be acquired, how long might that process take from start to finish?
Yeah, it's another good question. Almost every one of our clients says, our deal is going to be the fastest deal. We're not like the norm or the averages or anything like that. But at the end of the day, it typically takes 6 to 12 months to do a deal from start to finish. Unless they have an LOI or a letter of intent on the table, it's really a 6 to month process.
And in that 6 to 12 months, can you kind of tell us some of the steps that might be involved in that 6 or 12 months, or is it just getting paperwork together and that's why it takes so long?
So yeah, I think, one of the things that we pride ourselves on is running a very organized, methodical process. So the first phase is for the company to put together the marketing material. So it's the pre-letter of intent phase, and then the second phase is the post-letter of intent. So getting to the point where we're getting letters of intent and offers from potential acquirers, we work with the client, put together the marketing material. And one of the things that I think that we do really exceptionally well is that we put together a very large prospective buyers list, over 200 companies. Because when we do that, then we really feel like we've surveyed the market and we haven't left any money on the table. And so we get the best offers for our clients by going out to a very large list, which obviously is a lot of work, but we feel that we honor our clients the best by doing that.
There was a term you just said, leaving money on the table.
Yes.
Could you explain what that means?
So if we don't get the best offers for our clients, or if we don't market our clients in the best way, or we're not finding the best strategic acquirers, the companies that are going to be in the position to appreciate the company the most, to be able to pay the most for it, we essentially leaving money on the table. We're not getting the most for the exit for our clients. And so we really feel very strongly about making sure that we go out to a very robust buyers list, and also looking at the market from that strategic bird's eye view. How do we find the companies that will gain the most by acquiring our clients' companies?
So let's go back another term, strategic buyer.
Yes.
Could you talk about that?
Yeah, that's a great. See, you've got great questions. So there's typically two types of buyers. There's strategic acquirers, who are other corporations that are in, say, an strategic adjacent space. So they might be in an adjacent region, or they might have an adjacent product or service, and they acquire our client's company, and now they've got a larger offering. There's also the private equity side, the financial buyers. But the private equity side, a lot of them have portfolios or platforms, and so they're actually behaving much more like strategics, and they have a strategic benefit from doing the acquisition. So the two sides are actually coming together and bidding against one another, and so we've got a really great M&A market right now.
So a strategic buyer or a private equity group, I guess financial buyer.
Sure.
Are those deals, price-wise, pretty similar, or is there a big discrepancy usually?
They're becoming more similar because the financial buyers are acting more like strategics because they have other companies in their portfolios, and so they're looking for, to fill out their platforms, and so they have a strategic reason to buy the company, and so they're able to bid more in line with what the strategic acquirers can bid. So.
And you also mentioned marketing materials.
Yes.
Can you talk about that a little bit? Is it just like a brochure or flyer, or is it more detailed than that?
Yeah, so before we go out to market to find the best buyers for our clients, we put together 3 pieces of information. The first is a teaser email, which says just enough to get the buyer to sign an NDA to get the offering memorandum or the information memorandum.
So it won't have the company's name that's being sold or anything like that.
Exactly, right. And maintaining confidentiality is really important because we don't want competitors to find out that the company's for sale, or the employees or suppliers, because they can misuse that information. So the teaser email says enough to get the buyers kind of, lick it up and excited. They sign an NDA. Then they get what we put together, about a 30-page information memorandum. And this information memorandum has pretty much all of the really highlights of the company, the core competencies, the discriminators, the history, the financials, the operations, why this company is so phenomenal. And then the third thing we put together is that 200-plus prospect list of potential buyers that we go and market the teaser to. So we send the teaser out to the 200 companies. About 20% of them will sign an NDA, and out of that, they'll get the offering memorandum, and out of that, we'll get anywhere from 3 to 10 offers. So it becomes very exciting when that happens.
Are any of these companies that you work with, are they worried when they send out all this information, even if they do sign an NDA, that maybe these companies, once they see all the information, might somehow use that against them? Are they ever nervous, or does that NDA really calm the situation?
Certainly calms the situation, but that's a really good point, that you can't unring a bell, and there's all sorts of terminologies people use in the M&A field. You can't put toothpaste back in the toothpaste tube, things like that. So what we do is, before we go out to anybody, our client approves the list, and we typically will remove any competitors or anybody that could be potentially sensitive, because it's just not worth it to go out to them, that even if they sign an NDA, and even if they don't intend to misuse the information, once you have information in your head, you sort of can't operate without it. So it's better just to not even to send the teaser out to those companies in the first place.
So you're really working with your client hand in hand, making this list, sending out the teasers. You're with them 100% of these steps, is that right?
Yeah, we work very, very closely with our clients. It's really a marathon because it does take 6 to 12 months, so we have to have a good energetic synergy with the client and us. That's really important, that we, are working very, very synergistically with one another. And then the other thing is, we keep our client, not only do they approve everything before we send it out, but we keep our client updated every week, with an updated, response list. Because out of those 200 companies, we'll get responses from about 3/4 of them. And so we're always updating our client, and then we're also learning what the market is saying about this particular offer. So if we find that one type of strategic acquirer is really getting excited, then we'll market more to those types of companies, and then maybe back off from other companies. So we're always kind of moving, very agile. It's a very fluid process.
So it sounds like you're getting a lot of real-time information that you can go back to the seller with. How much of that information will adjust the price, adjust the terms? Is it all liquid, or is it pretty set from day one and you just tweak it a little bit?
So the market, the market's the ultimate valuator of any company. So, in terms of the purchase price, the terms, what's sort of going on in the marketplace, we're finding that out in real time. We may think that this type of strategic buyer is like the hottest buyer, they're going to make the best offers, and then never goes exactly to the plan. We've got, really good framework. We kind of know what to anticipate and expect, but we always get information from the market that does help us tweak that. Perhaps these types of companies are going to value this more. And the other thing is we never know what's in the strategic plans of the companies we're reaching out to, so that's why we keep a very wide list. Like we may think, oh, this company's not all that interested, and it turns out that that's in their strategic plan to go into this exact direction, and you never know. And so based on their questions, we learn a lot about the market.
So going back to the company itself, how is it that a company can get the best value for their company when they're going to the market?
So when we first get hired, and even if we're working with the clients ahead of, starting the process, we'll look at the company, we'll recast the financials. A lot of companies put...
What does recast financials mean?
Yeah, a lot of companies will put expenses on their income statement that maybe a strategic acquirer won't have those same expenses. Maybe they have an accounting department or an HR department. So we can actually subtract those expenses out, and it helps the earnings, the bottom line of the company. So the company's, now looking more valuable to a strategic buyer. The other thing is we can look at if there's any vulnerabilities where, say, the key engineering, technology, the technological staff, whether or not their intellectual property is very well protected. Do they have patents? Do they have trade secrets? Are the trade secrets managed in in a very controlled way? Are there change of control agreements in place? Let's say if there's a key supplier, is there a change of control in there? Is there agreements like retention agreements with your top technologists? So there's a lot we can do to help the transaction just go a lot smoother and also make the company more valuable.
So it sounds like there's a lot more to this than just looking at the bottom line of the company. I mean, you'd mentioned the key suppliers and the retention of talent. That's a lot of information for a purchase or a sale. And another question that our audience had was, what should the owner be thinking about during this process?
Yeah, so we always tell our clients, run the company as if they're not selling. That's helpful for a couple of reasons. One, because they won't take their eye off of the ball, because if they start taking their eye off of the ball, then sales drop. And the other thing is that the employees sense it. And so if they want to keep it confidential, they need to just run the company like they always have been running it. We're doing our process, sometimes we have to have a cover story, like who we are. If we're selling a company, like, I've done agricultural companies, I can't show up in a business suit. I have to go with my cowboy boots and jeans. And otherwise they think I'm the IRS, or something like that. But so sometimes they'll say that, like we're just doing an audit or an internal check or something like. So sometimes there's a cover story for why we're coming to the company and interacting with them. But we want the company to run as if they're not selling, so that they're focusing on sales and growth. Because sometimes deals don't go through, also. But also because we don't want the market to kind of catch wind what's going on.
When you're visiting these companies, is it you just visit once or twice and then that's it, or are you weekly, monthly, really going and checking out, surveying, investigating everything that's going on?
So in the beginning, the first month to 2 months, we're spending a lot of time with the clients. We're putting together the information memorandum, the marketing material. We're putting together the prospect list. And so we're spending a lot of time to really get up to speed on what's really going on in this market, in this industry, what's going on with the company, why is this company so competitively superior to its competitors, what's the discriminators. But we actually don't do a lot of visits to the company. A lot just gets done over phone calls and over email after the initial meeting. So typically we'll meet with the client, when we get hired, about a couple of weeks after we get hired, we'll have like a good afternoon, solid afternoon with the client, get a lot of information. And then after that, a lot of the interaction is done through, telephone calls and email.
And then what are the typical fees that an M&A advisor charges?
So on the investment banker side, we charge a retainer and a success fee. And so the success fee is very industry, kind of governed by industry. The retainer gets subtracted from the success fee. So what the retainer does is make sure that the company has skin in the game, because a deal could take a year, and so it just helps us to keep the lights on. But it also, then they have some skin in the game. They're not taking all of our effort for granted during that year. And then we subtract the retainer from the success fee.
And I've heard this term, earnouts. What does that mean, earnouts, and why is that such an important part of the transition phase?
Yeah, so what an earnout is that at closing, when the company gets acquired by the buyer, there could be some of the purchase price that will be paid in the future after the sale. And it could be, usually it's based on certain terms like revenue milestones, things like that. The value of the earnout is that sometimes the seller thinks that the company is worth more, and they're seeing the growth of the company, and so they want that benefit. The buyer, on the other hand, may say, well, we're not really totally sure that growth is going to happen, so you, seller, put that on the line. And so we try and discourage having earnouts, but a lot of transactions do have earnouts. Earnouts are the most litigated element of an M&A transaction. So what we tell our clients is make sure that at closing, you're getting the purchase price that you can live with. And then the other thing about earnouts is we keep it very close to the top line, so it's a revenue milestone as opposed to like an earnings milestone. And then the third thing that we do with our clients, we recommend that they stay on board during the earnout period, so they have the best chance of achieving the earnout. And they feel like they're kind of driving the ship to achieve the money that they will ultimately get.
So in an earnout, that seller might stay on board for 6 months, a year. What's typical?
Usually a year to 2 years. It could be 2 years. It depends on, every transaction is a little different. It depends on how long the seller wants to stay on, whether or not the seller likes the acquiring company. Some companies are awesome and they're happy to stay on, and some companies are, really not, not the right fit for that particular personality. And so, like, for instance, some large companies may be acquiring innovation or technology. Well, the minute they own the innovation or technology, they start trying to put processes in place, and and so they kind of squash the innovation. And so it really depends on how long the seller wants to stay on. Sometimes sellers want to stay on, as a whole second career. But typically we want to match that. If there is an earnout, that the seller stays on for that same period of time.
Wow. And for more information, please visit us at SiliconValleySuccesses.com. Follow us on LinkedIn, Facebook, and Instagram, where we provide up-to-date information on a lot of the topics that are happening here in Silicon Valley, and give you further information that's not on this show, but you could still benefit from and learn from at home. So visit us once again at SiliconValleySuccesses.com. And Chris, going back, before we'd mentioned some examples of clients you'd worked with when we were just talking casually, is there an example that you'd like to share with people at home?
So I love tech deals. I mean, I'm a physicist in my heart, even if that wasn't where I'm a Mozart. So any type of tech deals right now, artificial intelligence is very hot. I've got a client right now. We're doing artificial intelligence company.
Tell us about it.
I'm so excited about this client, this company, this opportunity. We know that several large companies in the Bay Area are already interested. We haven't even gone out to, or we're about to go out to market next week, and already we're getting interest. People are actually trying to jump the process. And so normally when we go out to market, we keep everybody in the same phase. But we have two very large companies that are going, well, can't we get the offering memorandum before? So I love this. When it's a hot technology, it's a company where they really focused on building a good, solid technology. They focused on quality and not on being the next WhatsApp, selling for $19 billion of Facebook. They just focused on, doing good in the world, and it's paying off.
And there's people that work on the buy side and the sell side. Which do you work on? one or the other, or both, and is there a difference?
So I come from the buy side, coming from a large aerospace company, so I am very familiar and very comfortable with the buy side. Most investment bankers work only on the sell side because, they come from the Wall Street finance perspective, whereas I came from a strategic acquirer perspective. So it's really very beneficial. Even when I'm on the sell side, I know how the other side thinks. I know how they build their business cases. So if they're not giving us the offers that I want, sometimes I'll even go in and say, well, here's how I would build the business case if I were in your shoes. But I actually work on both sides. So about half of my work is on the buy side. And on the buy side, I'll find the companies to acquire. So a company doesn't need to wait for, to know who they want to. I'll actually find the company for them to acquire. And then on the sell side, we find the company to do the acquiring.
So then on the buy side, would that look like a company would hire you, give you a retainer, and say, go find us 10 companies that have this type of technology, and then you just, for the next few months, go out and scout? Is that what that agreement would look like?
Yeah, so on the buy side, we'll work very closely with the client, where we will actually identify the adjacent types of industries. And it turns out there's adjacent industries, adjacent products and services, adjacent regions, adjacent customers. We'll identify all those different types of companies, and then we work with the client to see what's going to give them the most strategic upside from an acquisition. And then we'll actually go and source those companies. And so we start out with a list of 2,000 companies, and then we whittle that down to about 200, and then from that we whittle that down to about 40 companies, and then we have a way of hierarchically rating those companies, and then so it's done very very scientifically, and then I'll represent the client, say, hey, and I'll go out to those 40 or so companies and say, I've got a client that's interested in acquiring a company like yours. If you'd like to sign an NDA, I'll let you know who it is. But they don't know who it is until we sign NDAs.
Wow. And when you're working with these companies, either the buy side or the sell, could you represent both in the same deal, or is that not allowed?
Yeah, no, so it's not like real estate where you can do both. Right, we've got to be on one side or the other. Just ethically speaking, we have to always honor what's best for our clients. And so if I'm on the sell side, I'm working solely on the sell side on that transaction. If I'm on the buy side, I'm working only on the buy side.
And then what's the difference? Because I've heard some terms thrown around: business broker, investment banker, advisor. There's a lot of terms in the industry, but they're all different. How are they different? Yeah,
they're all different, and there's a lot of confusion. So a business broker has a real estate license, and they follow a more passive way of marketing the company. They tend to do more Main Street deals where they're looking for an individual to buy, like a dentist office or dry cleaners. And so they serve a very valuable element in the whole ecosystem, but there's a real estate component, and they're looking for an individual selling a company to another individual. On the investment banking side, we have a securities license, so we're regulated by a FINRA securities license, which is a regulatory arm of the SEC. So we have investment banking licenses because we're selling a security. So we're looking at selling a company or corporation to another company or corporation.
Oh, wow. So does the deal size matter with that? So would a business broker get capped at maybe $5 million, or is it just that a business broker works with mom and pop stores where the investment banker might work with the corporations?
Yeah, so it is actually kind of both. So the business brokers do the more Main Street mom and pop shops, and they tend to be capped at around $5 million, and then the investment bankers will tend to do the larger deals.
Wow. So to recap everything we've talked about the process. We've talked about different terms in the industry for business broker or investment banker. We've talked about your background from going to physicist to getting your MBA to entering the world of investment banking and going from the buy side working with, was it Lockheed Martin?
Yeah.
We've also talked about the going out and get from 200 people or 200 potential businesses down to those finals, the NDA, all this stuff. What did we leave out that would be very interesting for that startup to know?
So for a startup company, we always tell startups, build a company that people actually pay money for. So build a product and service, revenue solves everything. So here in Silicon Valley, there's a lot of, energy around angels and VCs and all of that. And that's all wonderful. We have an amazing ecosystem here in Silicon Valley. But companies, they can get investment. That's all fine. But they shouldn't take the eye off of the ball of building a good, solid company that actually can kind of like survive under its own weight, and bring in revenue, and then kind of keep growing and growing until it actually has earnings and profits. And yeah, maybe the investment money can help that process or speed it up or accelerate things. But I always tell startups, build revenue solves everything. So don't build a company thinking you're going to be the next WhatsApp. Build a company that really does provide a service or product that people will pay for.
And this might be a tough question. I don't want to put you on the spot.
Okay.
We've had people come in here and they've had mixed views on when a company should raise funding. What's your opinion? Should a company, as early as possible, try to raise funding, or try to postpone it as long as possible?
So I think it depends on the company, where they're going, what their aspirations are, how big do they want to grow, what the funding is used for. It really is all about keeping the end in mind. So where does the company want to go, and what's the best roadmap for getting there? And if raising funding will accelerate, beat out the competitors to market, gain enough synergies, sometimes you need momentum, then raising money is a good thing. But to raise money because they're not building something that actually is a service or product that people want to pay for is kind of the wrong reason. It's kind of like dipping into debt for the wrong reasons. Debt can be a really good vehicle, but it should be the right kind of debt.
And then, Chris, if someone at home wants to hire you, what's the best way to find out more information about you and your company, and also who is your ideal client?
So my ideal client is a technology company. It could be a company that's also not a technology company, but it's a company that has revenue between, say, $10 and $100 million. It's looking to exit, and they're looking to exit in a market that, is a vibrant market, and they've got realistic expectations, which, we never want to bet against our clients. So almost all of our clients say, we're the next unicorn, make it happen, Chris, it's all on you, and we're going to sell in 6 months. Understand that, we really need a good, solid year, and sometimes it goes quicker. How to get a hold of me, my website is monetavista.com, so www.monetavista.com.
Would you like to spell that?
monetavista.com.
Chris, thank you for your time today on Silicon Valley Successes.
My pleasure. What a blast.
And for everyone at home, stay tuned, because next week we have Pete Mackey, who's got amazing information on scaling your business and helping you when you enter a new location. And to find out more information about us, visit SiliconValleySuccesses.com. Check us out on LinkedIn, Facebook, and I'll see everyone next week.
Thank you from all of us at Silicon Valley Successes. We hope you found the information presented today useful in your path to success. For further information on accessing the resources in Silicon Valley, you may visit us on the web at SiliconValleySuccesses.com, on Facebook and YouTube. Thank you. And remember, we want to help you in your journey to become the next success.